Thanks for all for attending today. I think we're going to have a very exciting conversation. So here we have Darryl, co-founder of Tangent, Will, CIO of 100 Acre Ventures, and Jason, founding partner of Folius Ventures. So to kick us off, maybe you guys could just give a brief introduction to what you guys are doing and how you guys are thinking about investing in Web3.
Yeah, thanks for that. So my name is Darryl. I am one of the co-founders of Tangent, which is an angel fund specializing in very early stage pre-seed or seed startups in Web3. Previously, I was a principal from Defiance Capital and started Tangent 3 months ago.
My name is Will, founder of 100 Acre Ventures. We do a lot of investing in DeFi primitives, NFT primitives, and more recently a lot more in the kind of gaming and broader infrastructure space.
And I'm Jason. I founded Folius last year in September. We are a APAC founder and project-focused Web3 fund. And a lot of times we spend on the application layer as well as the infra and tooling SaaS layer at the bottom.
Awesome. Thank you for that. I think to kick us off, everyone here has very deep expertise in investing in Web3. I'd like to start with exploring the relationship between an investor and the builder in Web3. So in your opinion, how do you think having the right investor on board is important to Web3 startups? And what do you think are the best ways investors can add value to their portfolio projects?
Yeah, I guess I'll go first.
All right.
So I think it makes a world of a difference, right? Who do you have in your corner? Especially at the early stage is probably one of the most important decisions you can make. The right investor can make or really set you back as a protocol founder. So I think one of the most common ways that right investors can push you forward is really be, in the trenches with you, pushing you forward, be it pushing BD relationships, expanding the network, giving user feedback, try and sort of fine-tuning pitches to other investors or fine-tuning the strategy on how you go to market. I think that's super important, and the right investors at the early stage can really make a big difference.
Yeah, I certainly echo all that. I mean, for us, I would say it's a philosophy, but we've tended to only invest in things where we can add a lot of value ourselves as investors in the sense that we actually use the products or have some other way of providing expertise. So again, we've invested in a lot of DeFi primitives, but we also run a liquid hedge fund that in turn uses those same DeFi primitives. So there's a close loop in terms of the feedback we give because we're using those products. And that's been pretty consistent across all of the investments that we've made. I think likewise, we have a pretty large team from an operational perspective, and we've lent that to, again, the startups that we've invested in, which is an area that they shouldn't be dedicating resources, I don't think, themselves early on, and they can, again, outsource that. So either through our own, again, usage of the product and expertise or other operational resources is ways that we've tried to create synergies and add value, which again, I think helps create kind of a circular loop in terms of making them more successful, and of course, in turn, making ourselves more successful. So.
Yeah, I think Will and Darryl are roll up their sleeves type of investors, and I think we see that with a lot of Web3 funds in this space. I think further to that, if I were to add, a lot of the products in Web3 are very financially oriented, in the sense that future expectation on the assets that they're selling or creating really dictate the valuation or the premium of these products. So when it comes to the earlier stages, having the right or quote-unquote reputable investors on board could really help the trust and the premium of the financial product. So I think that's a often missed but quite important point. The other two things I would highlight is that when you compare a Web3 fund versus a non-Web3 native fund, when it comes to the native connectivity with other folks within the ecosystem at the earliest level, like, hey, do you know another Web3 protocol? Or do you know this founder that's just building a project? I've often found Web3 native funds to be much faster and much more well-connected when it comes to making that introduction. That's part one. And then I think part two for a lot of sort of these Web3 funds, they have seen a lot of mistakes that other token native projects have committed. So it's not necessarily showing what the projects can and cannot do. It's more so, hey, I've seen an example like this before that really blew up in their face, and here's the reason why. And I think founders oftentimes value those two type of things.
Very fascinating. We briefly touched on this as you guys were introducing how you think investors can interact with builders. What are some sectors, areas within crypto and Web3 that you think are generally being underfunded today? And what areas are you guys excited about?
Well, I guess underfunded is a pretty rare thing to see in crypto. I think most crypto verticals have plenty of capital to be deployed, as seen by the countless of billion-dollar venture funds that were raised in the last 18 months. So underfunded is pretty challenging, but I think one vertical I would say I'm pretty interested in is consumer-facing super apps. I think that is sort of a narrative that I think over time we will see grow, simply because the two most important things for Web3 protocols is number one, smart contract security, and number two, sort of your sort of market share and like market dominance over time. And so super apps basically, in order for you to be a super app, you usually have to have some sort of lindiness by producing an existing product already. And over time, as people get more trusted and trust your protocol more, you can begin offering alternative solutions that complement your original product. So for example, I think a DeFi super app makes a lot of sense because number one, you basically need to clear the regulatory hurdle once with the respective regulatory parties. And number two, once people start trusting your brand, for example, then you can start selling them, let's say, borrow lend services, DEX trading, perpetual trading, all on the same platform because once people are comfortable with their brand, they're okay trading other products, as opposed to right now how the market is and how fragmented it is, where you have to go to a different site every time you want to use a different financial product. I think that causes quite a bit of friction, opens up many different attack vectors, and just in generally has resulted in DeFi what we see today, where there's just a lot of friction, a lot of hesitation to use the products for fear of either being exploited or some other risk.
So we have a pretty broad mandate in terms of how early stage or late stage companies we invest in. I would say one theme that we've been focused on recently has been less on investing in the next DEX or the next primitive, or we've seen hundreds of iterations of some of these things, and more so on companies that are putting all that together in a more like tangible product. So again, kind of two areas we focused recently. One's a developer platform for game studios to kind of create, manage, secure your in-game economy. Clearly, there's a ton of hype around on-chain games. There's a ton of hype around NFTs. The difference here is providing this technology to existing game studios such that they can kind of pull a few small things out of it that help enhance the game loops, the economics of the game, and enhance existing video games as opposed to creating a blockchain-based game. Likewise, we've invested in called an infrastructure platform that makes it easier for full stack developers to incorporate certain Web3 protocols. So if you want to use Arweave or Filecoin for storage instead of an S3 bucket, it gives the developer the tools to do that in a very simplistic way. So kind of bridging the gap between Web 2 and Web 3, building products on top of these primitives versus just at the very kind of most nuanced base layer has been a big area of focus for us, because really that's kind of where we see again the next wave of capital coming in, the next wave of adoption is businesses being built on top of these things versus again kind of the 100th iteration of a lending.
Hello. Oh. I echo the 100x iteration part, which is let's just fork Uniswap on the latest layer one. I want to touch on Darryl's point a little more because he basically said what I have in mind, which is consumer type applications. I think by our count, which is by no means comprehensive, there are probably 3 to 5 million unique daily active users that are touching Web3 apps on chain today. That is a probably tier 2 sort of Web 2 app if you really think about it. I think the infrastructure in this space when it comes to layer 1 throughput, storage, and sort of fiat on-off ramp and KYC ML has just gotten to a decent place where we can now start thinking about increasing that 3 to 5 million by 10 to 100x. By extension, I think the easiest thing to do that, like Darryl said, would be a consumer type application. But we feel like there are a lot of people who are potentially sort of building shovels, but there are not enough gold diggers. So I personally am very eager to sort of back and find founders who are creating like a fitness app like Steppen, or creating a sort of browse to earn type web browser, or anything that is potentially already existing or doesn't exist in Web2 today, that could just have another million DAU into the space. And in extension to that, I think the mobile experience in crypto today is still horrendous. I think you should not be jumping around to another app called MetaMask to like validate your transaction. I think anything that smooths out the experience and potentially providing a second factor authentication type service could be quite useful. I haven't seen many teams building that. I think that's well worth funding. And the last thing is potentially not on so much the application or the product side, but at least in my mind, crypto itself is somewhat more politics and framework oriented. It's aside from technology, it's incentive design, it's aligning people's sort of profits in the right way. Because everybody was sort of like really busy building a product, they can't or they don't have time to think through things from a first principle perspective and just end up taking the design from other token projects. Why should we have a linear or exponential type inflation curve like Bitcoin? It doesn't have to be. Why can't we incentivize users that used to be stakeholders but no longer are, and why are we still paying them? So I think sort of aligning incentive type of token designs is sort of a frontier that not a lot of people really tackled yet. And I don't know how you fund that, but if the teams exhibit those characteristics, we're also happy to throw in a check as well.
Yeah, and just to add on to what Folius is saying, I think by and large, if you're trying to reach the next 100 million DAUs in Web3, you probably need some form of third-party custodial solution for tokens. I don't believe that 99% of the population will be able to comprehensively self-custody their assets on chain. I think that's a bridge too far for most people. And even now, like for a lot of Web3 users, people are consistently being concerned about getting exploited, getting hacked. This is just a user friction point, a friction user point that is way too painful right now in order to onboard the next 10, 100 million users. So a third-party custodial application, some form of wallet, I think it's needed. We've seen some attempts at it so far, nothing really pushing the boundaries yet, so keeping eyes open.
Yeah, there are definitely a lot of things to be built up in order to enhance the user experience of people coming into Web3 and interacting within Web3 itself. As you said, demand aggregators on the consumer side, tooling for developers to easily plug into Web3, and all these UX improvements that can be done. I'd like to move on a bit onto from the perspective of a founder who is looking to come into Web3, the ecosystem that they choose to develop on, the platform they choose to develop on, tends to be very crucial to the path they take to success, if they succeed. How would you advise projects in terms of choosing this ecosystem, choosing the initial partners to work with?
Well, I think it's very nuanced. A lot of it has to do with the founder's background, who they trust, who they know, how much they know about the respective ecosystems. If you're looking at a normal Web2 founder looking to get into Web3, chances are you're not going to build on some, the 10th most popular L1 just to like sort of have it as a USP, right? You probably want to start on an EVM-based chain or Ethereum, for example, and get going from there. But however, if you are very deeply knowledgeable about certain Cosmos-based applications, maybe you've had a lot of dealings with Solana-based developers so far, your expertise comes in the form of being able to write in Rust, then a different set of ecosystems open up to you. So it's really nuanced. I'd say that in general, I recommend most applications to build on EVM so far. That may change, and as more EVM bridges open up, that will open you up to different ecosystems as well.
Yeah, I'll give a different take on the same question. I mean, I think if I was advising a founder on that, I would advise them to be kind of as agnostic as possible. I think you could very well start one place, then end up on another chain in the future based on your needs. And I think starting with a chain that has solid network effects or is EVM compatible, I think that all makes sense. I mean, the two companies I mentioned previously, interesting enough, what part of their goal is actually to de-risk that for the kind of end users. They're more like B2B products. Let's just use this gaming developer platform, for example, right? Like the basic idea is, okay, I want to store in-game assets or an in-game currency on a blockchain, but I don't know which one that is. And so actually what they're trying to solve for is game studios not having to make that decision. It's like you give us the optionality to use a blockchain as the data store, to have a marketplace, et cetera, but I don't want to choose that now, in part because we don't know who the winner is, whether it's Solana or Ethereum or the next other 12 L1s that will come out over the next 2 years. So again, most of the things that we've invested in recently are actually trying to remove that decision from the end customer, which is again different from your original question. But again, I agree with much of your original suggestions on if you had to pick a chain. I would think about it as being as agnostic as possible.
Yeah, I generally agree. I don't have that much more to add. I think if you know Solidity and you don't know Rust, I mean, it's probably pretty dumb to build on Solana. I don't know.
I guess one thing I would say is I would be cautious of if you have an investor in your cap table who's pushing you to build on a specific chain because they themselves have invested in that chain. I would just be cognizant of the alignment of interests, if you will, and try to take a kind of zoom out and think, what's the best product or chain to build on and why, and be as objective as you can.
And also definitely talk to as many foundations as possible, because there are certain ones are very well funded. They are sometimes getting their check means more connectivity, means more support, means more connections. And also they're just a little looser in terms of funding. They would give you 200K, 500K, no problem, when you're supporting the ecosystem. And alongside with that, I think I've seen many founders. I think when you're hopping onto an L1, there are VCs that are very closely associated with those L1s. And oftentimes, if you're building a support type project that helps the ecosystem, I think getting funding from those specific VCs might also get easier. I guess fundraising is not part of the discussion, but it's kind of worth bringing up.
I would add as well that one thing to be wary of is hopping onto the next L1 that seems to be all the rage at this point in time. I think it's very, very dangerous if, let's say right now, ecosystem A is the most popular because maybe they just launched their conference, they've got a lot of hype going on it, the token price is pumping, for example, and then you think, okay, then maybe it's a good idea to launch on this token because it's getting a lot of hype. Usually it doesn't last, and when you're building something for a 3 to 5 year time horizon, you want to pick something with a bit more stability.
Is ecosystem A intended? The A, is that intended or is that?
No, as a pure example.
Oh, okay, yes.
Don't read into it.
No, okay.
Okay, yeah. I think a very common theme throughout this conversation has been how path dependent the building in Web3 is. Like once you launch a token in a certain area, if you screw up the inflation too much in the initial days, you put your token in the wrong hands, it might create second order negative effects as to how your product develops. So I'm curious to hear all of your takes on, I guess, the way tokenomics should be conducted. Like just broad principles that you think founders should adhere to, or maybe some pointed view as to what founders are doing wrong when thinking about tokenomics.
I guess my first question is, does the product need a token? Because I think a lot of things, will raise money through a token, and then you can kind of question whether a token is required. So that would be my first question about token economics, is a token or not. I'm probably the outlier within crypto ventures of not wanting to see a token with every single investment that we make. But because I think it's a very relevant question for a layer one and potentially some dApps. But then again, you start getting to a point whether, I know this is not where you're taking the question, but whether it's required or not.
I'll jump in. I agree that not every project needs one. I think the cash flow that comes into a project, there's a security destination, but if you exert proof of work, the token probably can have value accrual. Upon when a token is launched, I think the team has to make a decision as to when the cash flow comes in, does it go to equity or a token? And the decision to make a token, part of it is also, I think a lot of teams decide to do it, is that oftentimes the risk premium that a token can capture in the public market comes way sooner. and it comes at a much higher valuation than equity would. So you create a project, you create a token, $5 billion valuation, dump it, make money, and move on to the next one. I think the one pitfall I would, if you were to go about with a token, is I think having a market price being set on your project on a token side drastically limits one's maneuverability in terms of setting the valuation for your future fundraisers. OTC rounds, when the company needs to sell treasury, often happens at a sort of 30% to 70% discount to the then prevailing secondary market price. So launching your token at the wrong time at the wrong price would basically mean potentially being shut out from the fundraising market versus a project that's still private. That's part one. The two other points I can probably make is that having a token as potentially incentive to the users when using your protocol could potentially drastically change the user profile. And I think there could be more designs that, for example, instead of earning a lot of money, maybe capping it to just earning your money back for certain type of activities. Upon that kind of design, I think the user profile becomes from moving from a pure user to something extremely rent-seeking to maybe still a user, but just kind of want a bit more money to be earned from using your product. And then the last thing, and I think this is still very much an experimentation, is that you have to be really cognizant of sort of forcing your users to come back and contribute to your projects after they have gotten the token. If you sort of give them a bunch of tokens up front for what they have done and sort of allow them to just sit on the tokens and do nothing afterwards, I don't think that's extremely healthy design. So you just kind of be very cognizant of it when you're designing the inflation mechanism.
Yeah, and just to add, I think first and foremost, the introduction of a token has to fundamentally improve the value proposition of the protocol. If the token does nothing and serves as just a speculative vehicle for the protocol, you probably shouldn't be launching it at the time. So number one, it has to improve the user experience in some way, be it improving the security of the protocol, further decentralizing the protocol, improving the user experience of the protocol, for example. These are several examples of how it can be done. The second thing is that I think a token, if you do launch a token, I have the view that the token should be the main vehicle where value accrues. And this is debatable because in a lot of real-life examples today, you have value accruing to both the token and the equity in, perhaps not the fairest ways. So I'm of the view that if you do launch a token, 100% of the value should accrue to the token, and your token holders should be able to receive rewards or dividends as such, right? I think a token should be thought of as an improvement to equity, as sort of an ownership vehicle of whatever protocol that you're building. So these are the two things. And lastly, I think using tokens to bootstrap initial adoption of the protocol is you have to be very measured with it, because a lot of times you can fall for increased usage or increased activity of your protocol and perceive it as product market fit, whereas in reality, it is just users farming your token, and once that token incentive is gone, your users are gone just like that. So that's something that has to be, really thought of. And this isn't to say that you shouldn't be using tokens to incentivize people, but it should be done in a pretty measured way. And I think right now, protocols have sort of understood this playbook or this narrative to an extent, and have been able to put out measures that consistently engage with the users, and also give them, a little carrot at the end of the line for them to continue engaging.
Just piggyback on your comment, I can't agree more in terms of having a token that accrues value. So if there's adoption of this, company, this app, etc., that value should accrue to the token. What's frustrating in the space right now is that there's this kind of like regulatory barrier for this always happening. So I think OpenSea and LooksRare is a good example, right? Where like LooksRare's token actually I think is a very clean token economics in the sense that if you stake Looks, right, you get your pro rata share revenue on the platform. So it's actually a pure pass through of equity, which to me is a very clean token design. But a lot of companies don't do it because then you're worried about looking like a security. So they have an anon team, they do it, it's fine. And then you have these other kind of like, I won't say convoluted, but these like workarounds like, oh, well, the value accrues to the treasury. This is a governance token. At some point in the future, we'll figure out how to get this governance away. So there's these kind of like hurdles that people are navigating, I think, unfortunately because of regulation that gets in the way of having that perfect alignment. But I think where we all want this to go is exactly that. You want that perfect alignment. And there are cases of that out there. And there's unfortunate cases where it's not aligned, not because the team doesn't want to do that, but just because of other hurdles, in this case, regulatory. So.
Awesome. We briefly talked about product market fit. I think Darryl, your point was very crucial there. Let's talk about founder product market fit. Like, in your opinion, where do you see the most successful Web3 founders coming from? Where do you see common themes between founders you think will do better in the Web3 space?
I wouldn't say that there are noticeable common traits specific to Web3. I mean, all successful founders will have several, common traits in any startup, right? But I think founder market fit is a pretty important aspect that we look at when investing. Basically, the question we're trying to answer is, how does this founder, is he uniquely positioned to solve the problem that he's trying to solve? Right, and sort of we're hoping the answer is yes, so that we can continue with the investment. But oftentimes, you want to find people that have a particularly different history or track record with a particular problem, or he has spent 10, 15 years in Web 2 trying to solve the same problem, and he's moving into Web 3. Right. So are these guys experts in their particular field, ready to solve that problem where no one else can? I think that is pretty important when you're trying to invest.
Yeah, I was going to say, I think people who have experience in the industry that they're trying to disrupt, or they're Web 2 founders that have kind of ramped up their knowledge of Web 3 and have found a way to kind of apply that to solve a unique problem is where we find the best founders. I remember going to this like DeFi meetup in San Francisco 2017-ish. It's talking about over-collateralized loans. Everything's over-collateralized. Like, what if we had under-collateralized loans? It's like, you realize the entire financial system works with under-collateralized lending. So it's like these like novel ideas that this like group of, again, very like ambitious entrepreneurs were talking about, and like you just realize, how about if you just bring a couple people who have spent if you pair that together, people who spent their time in that industry, whatever you're trying to disrupt, I think it's a good combo. And sometimes I see the overzealous entrepreneur who has no experience in the industry they're trying to disrupt, which is also there's some benefit in that. But I think pairing it with someone who has that legacy experience as well is not a bad thing to do. And the best teams that we've invested in, I feel, have kind of a pairing of both.
I echo that point a lot. I think I don't know. I usually go to meetings if I've looked at their pitch deck, which sometimes happens. I usually will have problem about that specific domain, which is oh, you must have thought about A, B, C, D issues, and the best type of founders I've come across is usually when I raise a question and I hope I myself have kind of an answer, they just absolutely crush me. They're like, oh, I've already thought about it. And they might not have the solution, but they're like, oh, wait, I've already thought about it, and I'm like 3 steps ahead of you. And by the way, you've defined a question wrong. And here's how I really think about this. Those, to me, tend to be the best founders, aside from them grinding very hard and having domain expertise. The ones I could improve on is like, oh, I actually haven't thought of that issue. And I'm like, well, I'm not an expert. Like, you should be the expert. How come you haven't thought about this and you're like building this business? Shouldn't be the first thing that you ask. And I oftentimes found like the first group tend to be a bit more successful.
Great. You have anything to add, Will? Awesome. I'd like to just have one final question. What is your number one fundraising tip for people looking to build in Web3?
You're supposed to cover the questions ahead of time.
It doesn't have to be fundraising. It can be. What is your number one tip?
Raise enough, but not too much. I think the goal, if you're trying to raise, at least if your first round, 2 to 3 years worth of runway. If you raise because you're in the height of the bull market and you raise the maximum you can raise simply because you can, chances are after that incentives get a lot more muted. When you have $100 million in the bank for no reason, all of a sudden we see founders start doing things that they really shouldn't be doing. So Yeah.
Yeah,
Will?
it's a fine line of staying hungry versus having some reserve if you're going to go into a market where it's going to be difficult to raise. This probably goes without saying, but I think you should have a clear explanation of why you're raising, or like how much you're raising and why. And it's fine if you have like a buffer because we're worried about being in 2 years. But I've talked to a handful of teams where they basically pick a number because they saw two of their peers have a similar number, and it's like an ego type thing, or it's a this is where the market's at. And to me, that's just not a very good answer. So again, I think you can skin the cat a lot of different ways, but you should be pretty clear as to what you're raising, how much you're raising, and why, and what's the objectives of that money. Which again seems kind of self-explanatory, but.
And I would say ask for recommendations or referrals to, and pick your VCs carefully when you go to market.
Fantastic. Those were great answers, and we thank you so much for attending this conversation, and we hope to see you guys around. Thank
Thanks.
you.